So in today's ride with an accountant, I wanted to talk about the sale of a contract. And this came up because a client of mine reached out to me the other day, and they were in the process of selling a contract. Now, in this particular case, the client, they were approached by a buyer who they were not interested in actually buying the company, but they wanted to buy contracts that this client had with particular clients. Not all of them, but there were some specifically that they wanted to acquire. So during our conversation, we were trying to figure out the tax treatment of selling these contracts. So from looking things up and giving the advice, I thought initially we would treat the sale of the contract as a capital gain. The contract being sold was considered a capital asset to be sold. However, upon doing more research and looking at past rulings, such sales would actually be deemed ordinary income. Now, for those who don't know, the tax rate between ordinary income and capital gains can be vastly different. So with this particular client, they would have been in the top tax rate for ordinary income, which on the federal level is 37% given the sale. But had the sale been treated as a capital gain, he would have been looking at a tax rate of roughly 20%. Pretty big difference. So once I came back, reported to him that he was pretty disappointed that this sale would be treated as an ordinary instead of capital, obviously paying a bit more in taxes. So what we were able to do to work around this as a solution is to create a new company. I believe we specifically did it as an S corporation. Created a new S corporation, and what we then did was assigned those contracts to this S corporation. And what we then did was approach the buyer and said, hey, we know you want these contracts, but we would like you to purchase the company that now has these contracts. There's nothing else in the company. The companies were brand new. The company was created for the sole purpose of selling these contracts. So what we wound up doing was placing these contracts in the company and sold the company to the buyer. And the reason why we wanted to do that is because now when the buyer is coming along, they're now doing a stock purchase. They are purchasing the company and not necessarily the contracts. Now when you purchase stock, in this instance, it's a closely held company, but just like with any other publicly traded stock or closely held company, it's a stock transaction. Stock is considered capital assets, which in turn would now qualify this sale, as a capital gain. So that's something that we came up with as a workaround so that my client would now be able to take advantage of the lower capital gains tax rates at 20% versus facing 37% at ordinary. Something that you may be able to do or consider if you're selling assets that may not be considered capital assets in the eyes of the IRS, create a company for it, place those assets in, and then sell those assets. All right, that's all for now, and see you in the next one.